Good afternoon and welcome to today's webinar, Restarting the Secondary Markets with Major Lindsay in Africa and our guests from Davis Polk, 17 Capital, and Sixpoint Partners. My name is Heather Nielsen and I work on the marketing team here at MLA. I will be in the background answering any technical questions that you have. If you experience any technical difficulty at any time during this webinar, please submit your questions to me in the Q&A panel and I will assist you. Before I hand this over to my colleagues, Brian Davis and Dimitri Mastrocola, to kick us off, I'd like to run through a few housekeeping items. So you should all be able to see my screen right now and hopefully hear my voice. All attendees are in listen-only mode for the duration of the presentation. And as a reminder, the call is being recorded. The recording as well as the slide deck will be available on our website in the next few days. Today's webinar will be approximately 1 hour, including Q&A. You may ask us a question at any time throughout the event, and we encourage you to do so. At the top right of your screen is the GoToWebinar panel. Just open up the console, type a question, and hit submit. Your questions will only be visible to Leor and myself and not the other audience members. We will try our best to respond to them during the presentation. We will also launch 4 polls during the event to keep you engaged and help add to the conversation. At the close of the webinar, a short survey will pop up on your screen. We hope that you'll complete it. It's short, 7 questions in total, and shouldn't take more than a minute or 2. And lastly, regarding CLE, the forms are available to download in the handout section of the GoToWebinar console. Please download them now. We've included the actual CLE form itself in both Word and PDF format, as well as an outline of today's presentation and also an article on liquidity solutions for private equity funds in the secondary market. We will also send them to you after the call in our follow-up email. The actual MCLE code will be announced during the presentation. You will need that code to add to your forms to get your CLE. The CLE form needs to be returned to Lorraine General at Davis Polk after the call to obtain your credit. Lorraine's email is detailed in the form. And lastly, as we have multiple speakers on the call today and they're all on webcam, you can choose to see everyone's cameras. Only the presenter's camera, the person speaking at one time, or everybody, or no camera at all. Simply click at the camera drop menu in the top of the viewer or control panel to choose your viewing selections. If you have questions, I'll be here in the background to assist. Now, I'd like to turn this over to my Major Lindsay and Africa New York City colleagues, Brian Davis, to introduce our guests from Davis Polk, 17 Capital, and 16 Partners. Thank you.
Thank you, Heather. Thanks everybody for coming. My name is Brian Davis. My partner, Dimitri Mastrocola, and I, Dimitri's also on this panel, we're both partners at MLA, and we head the financial services group of our in-house legal placement business. I noted when we started arranging this that this is almost exactly the 12th anniversary of our lunch series. We kicked this off right after Lehman's bankruptcy and AIG's collapse. I saw that Fred Fogel signed up for the webinar today, and I know Fred was at the first one, so thank you, Fred, and thank you everybody who supported us over the years. Dimitri and I appreciate it greatly. It's been a big, big success. I hope, not that I don't love webinars, but I hope this is our last webinar and we can be back in the Princeton Club sometime early next year. Thank you to Heather for doing all the hard work to make this work so smoothly and make us look good. As Heather said, there's CLE, make sure you fill out the form, and please ask questions. We find that when these things are interactive, they move along much more quickly and are more interesting. Finally, thank you to Leor and the good folks at Davis Polk for setting this up. I will turn this over to Leor and he will introduce the other panelists and we'll get started. Thanks again.
Okay, thanks Brian, thanks Dimitri, and thanks Heather, and thanks to everyone at Major Lindsay. I saw a lot of familiar faces that signed up. I guess we're going to see you. We don't get friendly faces, but we have familiar names at least, and so it's nice to see everybody. And thanks for joining. And thanks, Brian, for that wonderful introduction. It's always nice being compared to the greatest collapse of an investment bank and insurance company in the history of the world. It's always nice to have that in the lead-in to a panel. So thanks for that. I am Leor Landa. I'm a partner at Davis Polk, heading up our funds practice. And spending more and more time over the last several years working in the secondaries market. We started working in the secondaries market back in 2008 and have been at the forefront of it as it has evolved, as you will see in a minute, evolved very rapidly over the last decade or so. We are very, very lucky. More importantly, we're very, very lucky to be joined on this panel with Andrew Gulotta and Richard Golaszewski. Rich is an investment director at 17 Capital. He got promoted from 16 Capital to 17 Capital. He's investment director at 17 Capital, responsible for the preferred equity and fund NAV financings in North America. And he's someone who's very familiar to Davis Polk, doing excellent work with some of the most sophisticated NAV financings over the last decade. Before he joined 17 Capital last year, he was at Nomura for about a decade. He was in 2018 named one of the young guns of secondaries, which is kind of the highest honor you can get as a professional in secondaries. One, because it means you're still young, and two, it means you're really good. And then he began his career, actually, to bring it full circle to Brian's introduction. Rich began his career at Lehman, so more than 12 years ago. We also have Andrew Gulotta, who's a partner at managing director at Sixpoint Partners. Sixpoint is one of the leading intermediaries in the secondaries space. Andrew's managing director in the capital solutions team, focusing on secondary advisory and direct equity placement for funds. He has specific expertise in GP-led secondary transactions, which is becoming, as you'll see, more and more important in the secondary markets. He helps fund managers generate liquidity and follow-on capital and come up with bespoke solutions for issues. The secondary market has become more and more bespoke and more sophisticated in solving a lot of different issues that come up for fund managers. Before he joined Sixpoint over a decade ago, actually he's been at Sixpoint since 2009. He was at JP Morgan and had spent a number of years there. So with that, and I have to say we're very lucky to have them. They are both leaders in the secondary market with particular expertise in the types of deals we're going to talk about and the types of deals that I think are going to be relevant as the secondary market restarts heading into the really the fourth quarter of this year. If we could go to the next slide, please. Thank you. So I thought I would start by spending just a few minutes setting the stage for our conversation. Even though I'm a lawyer who's paid by the hour, I'll try to keep this quick. I'm not getting paid for this, I guess, so I have all incentive to keep it quick. I thought we'd just set the stage on the secondary market, what it looks like now and how we've gotten there. The secondary market really has evolved just over the last 20 years or so. And if you go back even just 12 to 15 years ago, it was a very small, very fragmented, very inefficient market, trying to provide liquidity for limited partners in inherently illiquid assets, in particular private equity, but also VC and real estate, although the traditional private equity, leveraged buyout type of funds have dominated and continue to dominate the secondary market. Because of the liquidity of those assets, people would at times look for liquidity, and the secondary market has evolved as a way to evolve at first as a way to provide liquidity for people who are holding illiquid assets. Initially, as it was this small, fragmented, inefficient market, it was a sort of forced seller, heavily discounted market. Coming out of the financial crisis, it really took off as a market, both in its size and efficiency, but also in its sophistication. It grew from about a $10 billion annual market in 2008 to a roughly $90 billion market last year. In about 2013 or 14, there also emerged this notion of a GP-led segment, which is expanding the notion of secondaries, not just to buying out limited partners, but also providing direct solutions to general partners for funds that have liquidity needs or looking to solve particular issues, whether it's delays in realizations or a desire for follow-on capital or the need for more financing. In 2013 and 14, those types of deals were sort of considered rescue financings. They were sort of for GPs that were stuck with assets coming out of the global financial crisis. It was taking a lot longer for things to get resolved. LPs were getting annoyed. And this was a solution that was really brought in to help kind of fix assets that were in trouble, with LPs that were getting frustrated. It was a kind of a creature of necessity. What has happened over the last 7 years, though, it has really evolved into another tool in the toolbox. I'm copywriting a phrase. I call it the fourth exit for sponsors. You know, historically, you could, if you're looking to realize an asset, you could sell to a financial sponsor, you could sell to a strategic buyer, you could IPO and sell to the public. Now we have a fourth exit. Again, copyright Leor Landa 2020. We have a fourth exit, which is you sell to yourself, which is really what the GP-led secondary market does. Is it allows fund managers who like an asset to provide a liquidity option for their investors while still retaining the asset and allowing for additional growth. Once the GP-led market started, it started with tender offers to limited partners. It evolved into continuation vehicles, into single asset lift outs of particular investments, and it was also now evolved into preferred equity and NAV-based financing solutions for funds, which is something we're going to talk about in a lot of detail today, and something that Rich and Andrew are both expert on. As the market has grown, like I said, it's a $90 billion market now. It's matured. It is a much more efficient market now, with big institutional players involved, with intermediation, like with Sixpoint Partners being exceedingly important in increasing efficiency and finding price transparency. And the players have also evolved and grown and institutionalized. Maybe you can move to the next slide, please. Thank you. So this is just a chart showing volume very simply. You see it grow from a relatively small market back in the early 2000s, like I said, to about a $90 billion market last year. What is interesting is if you look from 2016, I'd say, to 2019, roughly 35 to 40% of that market is in the GP-led space, whereas if you go to 2013, roughly 0% was in the GP-led space because we hadn't invented it yet. And so a lot of the growth in the market has come from GP-led and what we would now call transactions. Next slide, please. As a result, you see the market growing pretty dramatically. It is a 5 times larger market. There's a tremendous amount of dry powder currently in the market, with approximately $45 billion of funds raised in secondary dedicated vehicles just in the first half of this year alone. Now, one thing to note, one interesting tidbit that I heard last week, which is while there has been this dramatic 5x growth over the last 12 years, it has generally grown in line with private equity. And what I mean by that is transaction volumes still tend to hover around like 1 to 2% annually of private equity market size. And so it's not like the secondary markets are overwhelming private equity. It remains sort of on an annual basis 1 to 2% of the size AUM of the private equity markets more broadly, and its growth has been commensurate with private equity growth. So I think you look at this chart, it feels like a big exponential growth, and you wonder where it can go from there. But actually, at 1 to 2% on an annual basis, it's still a pretty relatively small piece of the private equity market. Next slide, please. Now, I'm going to shut up in a minute, but just to set the stage for this conversation, what happened in the first half of this year, and now almost the first 3 quarters of this year, has been really a tale of twin and what appear to be opposing stories. When March came, the secondary market really collapsed, and as you saw on that volume slide, it went from $90 billion last year to just about $15 to $18 billion in the first half of this year. It's about 57% decline in transaction volume from the first half of 2019 to the first half of 2020, a fulsome collapse of that market, with most of the deals that got done kind of launching before COVID. So a real dry spell for the traditional secondaries market. And if we think about traditional secondary market, it's LPs selling their stakes in funds. And the GP-led market also relatively shut down. I can say I had 8 deals die in 10 days in March, which I have to say is a record that eclipses even what happened back in the global financial crisis. That's one side of the story. The other side of the story, however, is that fundraising for secondary dedicated vehicles was at a record pace at the first half of this year, $44 billion raised, which was more than was raised in all of 2019. So you see an acceleration in fundraising for secondaries while the market really dried up. And I think that reflects a general consensus that this is actually a very good time for secondaries investing. The pricing environment is better, and people are expecting there to be a tremendous amount of volume in the secondaries markets over the next 6 months or so. So we're sitting here now, and depending on who you ask, somewhere between $125 and $150 billion in dry powder, which is a record. The drivers for secondary transactions remain the same. Demand for liquidity, solutions for portfolio management financing. There are new ones added. I think there are new drivers like delayed exits from your portfolio because of COVID. Now, I will say, if we look at the last 6 months of the year, while the traditional secondaries markets were paused, other liquidity solutions gained a lot of steam. And in particular, two things we're going to talk about a lot today. One is preferred equity fund level financing, and the other is NAV-based lending at the fund level. And we'll talk about the reasons why those were very active, but they are deal types that can proceed and provide financing for fund portfolios, even when there is a real disconnect in the valuations, right? Where there is disagreement between buyers and sellers between what the value of underlying assets is, or at least a lot of uncertainty around valuation. Maybe I'll pause there for a sec. We have 4 polls. And Heather, if I could ask you, maybe we can throw the polls up right now. So the first poll is, and sure, I'd ask everyone to answer this question, everyone in the audience. Did your firm have an exit event postponed by COVID-19? Were you lining up for a realization or the expectation of realization and have it put on hold?
Leor, I'm going to give it till it gets to about 75, 80% to see, give everybody a second or two to answer.
Okay.
Okay, well, the answers are going to stop coming in, so I'm going to show the result.
Great. So it looks like about a third. It looks like about a third of the people here, 33%, had an event postponed by COVID, and that is probably about right. I actually would have thought it would come in around 50% of firms were expecting a realization event, and the event didn't happen. It was postponed because of COVID. Now let's do the next question, please. Did your firm explore a fund level financing or similar alternative? So especially for those who had a deal delayed, did you look for an alternative financing, whether it was NAV-based lending or preferred equity or some other solution? Give it another 10 seconds or so. Maybe you could throw up the results. So it comes out about 20% of people explored fund level financing and 80% didn't, which doesn't surprise me because I think there are a lot of misconceptions and misinformation and lack of information about these financing alternatives out in the market. And so actually part of the purpose of this is to make sure people understand what solutions, what options are available to them. Let's do the third question. Did your firm actually execute one? I have a feeling that I understand was maybe just of the 20% who said that they were examining one, of those 20%, maybe you could just answer whether you actually executed one. Yeah, if you could put that up, I think this is actually the answer I was planning, and I think is the reason we wanted to do this session, is because what we found over the last 6 months is that even though there were good financing solutions available, not that many people kicked them around, I think because it wasn't as well known in the market, and the people who didn't execute them with any regularity. And that actually was the impetus for this panel and this discussion, because we think it's a missed opportunity. And now if we could just do the last poll.
Oops. I don't think it worked. My apology. Just read the question to them, Leor. Sorry, my internet's going out again. I apologize. You can explain to them what's going on.
All right, let me, I actually have to pull up the question. Oh, there it is. As you think about year-end priorities and plan for 2021, for each of your firms, what do you think is most relevant? Is it an alternative solution like a NAV-based loan or preferred equity to provide fund-level financing? Is it a full liquidity option for using a GP-led secondary or continuation vehicle? Is it a single asset continuation vehicle, which is becoming a more and more attractive deal type, or none? You're not really looking to finance or find liquidity solutions. And I don't know if we're able to, are we able, Heather, to get people to vote or no?
No, because my wife, as you know, my internet just went out again, so it got stuck. Sorry about that.
No worries. That's fine. Let's go to the next slide. So that actually set the table perfectly. I think the real meat of what we wanted to talk about here is two things. One, give people a bit of information about these alternative solutions in the secondary market that we think are attractive in a period of price dislocation. And then also, I think the next and last slide will just be to talk more generally about what we're seeing, what we're expecting in the restart of the market. With that, let's turn to the alternative solutions, and we're going to talk about a few things. One is preferred equity and NAV-based lending. Another is what we call shared waterfall or structured waterfall structures. And the last is early stage secondaries. Alternative structures accounted for about 15% of first half 2020 transaction volume. By our best measures, it accounted for about between 4 and 5% in recent years. It's sort of a tripling of that market in this year because of its attractiveness. And with that, why don't I shut up, and Rich, why don't I ask you to talk to us about preferred equity and NAV-based loans?
Sounds good. Thank you, Leor, and thanks to the Davis Polk and MLA teams. So at 17 Capital, we really categorize this world broadly as portfolio financing, which is working with PE investors. That can be a GP at the portfolio level, that can be a GP team or fund management company, or it can be an LP or co-investor to help them raise capital against their portfolio to either to continue to grow that portfolio and make additional investments, or to accelerate liquidity. We have seen COVID as one of many accelerants to deal volume and to more and more transactions. But I think moreover, it has been overall adoption, overall growth of this market. Much like the GP-led secondary market, this is no longer a situation-specific type of deal. This is, as Leor mentioned, this is another tool in the toolkit. This is allowing investors to be opportunistic. Big picture, what goes on in one of these deals? There's flexible financing being raised against net asset value, where those proceeds are going to flow into the portfolio, or they are going to be sent back to investors or to shareholders. These are transactions that are quite flexible in nature. They, from a preferred equity perspective, think of this really like a senior LP or a senior equity investment. There's no maturity date, there's no security or collateral, there are no financial covenants, and there is no cash interest. The preferred equity provider, like a 17 Capital, is being repaid only as and when there are distributions that are coming off the portfolio. What has been a new development in this market is the NAV loan market, which we've really seen grow out of the preferred equity market that we pioneered 12 years ago now, and that is looking at lower loan to value opportunities in slightly more diversified portfolios where in exchange for a lower cost of capital, this is more of a senior loan structure. So there is a fixed maturity date. There is a security package. There are some basic financial covenants, and there is an element, at least, of cash interest. What I would stress is that this is a very new market. I think there has been more chatter about these transactions than deals actually happening. But one of our theses and one of our predictions is that for the rest of this year and for next year and the following, there will be a lot more NAV loan deals that are both contemplated and executed. What are some of the pros here? Compared to other forms of capital raising, this is a very flexible solution. It can be executed quickly. As Leor mentioned, it is less dependent on what the valuation is. Given the typical LTVs that we are looking at, we as capital providers aren't as concerned about is the portfolio worth 95? Is it worth 105? Is it worth 100? We want to understand it broadly. We want to understand the underlying companies, who is the manager, and what amount of financing are we comfortable putting forward. And these are deals where typically quite a large deal size can be executed by a single counterparty. At our shop, we generally look at deals between 50 and 500 million.
Yeah, and I think COVID provides a jump start for that market. I think preferred equity was already building. I think we estimated about $3 billion last year, which was a huge spike from years past. And so the momentum there was already building for preferred equity. And NAV-based lending, it was kind of right behind it as a growing wave. I think COVID gives it a real kickstart because, like you said, Rich, it doesn't really matter whether you agree that the portfolio is worth 95 or 100 or 105, which matters a lot when you're doing a secondary transaction and actually trading in the assets. Here, if you're doing an LTV of, let's say, 33%, 50%, as long as whether you mark it at 95 or 100, as long as your mark allows you to provide enough financing to achieve the solution that the GP and LPs need, then you really don't need to reach agreement on the price. And that has been, in this period of dislocation, has been a tremendous benefit for those types of deals. And then also, like Rich said, I think the speed for execution and the likelihood of execution was very helpful in the downturn, where suddenly some people needed financing, or either defensively or offensively, either to take advantage of opportunities or to protect assets. And knowing that that can be delivered and delivered quickly from a sort of boutique type of lender, that was really an important. I think that's why a bunch of people started looking at it more aggressively. So thanks, Rich. Andrew, maybe I'll turn to you. I think I'll skip over shared waterfalls for a sec, and maybe we could just talk about early stage secondaries and why we saw an uptick there this year. This is sort of more LP side.
Yeah, absolutely. And there is somewhat of a GP context to it as well, which I can talk about. So in early secondaries, kind of exactly what it sounds like. It's a fund that's less mature, right? It's earlier in its life cycle, and what became kind of not. Again, there were a lot of, I'd say, potential transactions during the outset of COVID that didn't have to always take place, but people were very freaked out about liquidity back in March and April. And so some of the transactions, while the volumes were very low in Q2, some of the transactions that did get done were these early secondaries, where it was not just about freeing up cash for the selling LP, but really it was about unfunded release. So if an LP had committed, say, $100 million to a large buyout fund, and only 20% had been called, what's more important to them is getting out of the remaining $80 million of commitment. And that became a conversation that a number of LPs were trying to have, but many of them wanted to have it quietly. They didn't really want to let people know that they had, call it major liquidity concerns. But it's it's a very good solution, particularly to get out of the unfunded commitment of a fund. Kind of flipping the script, there is a GP context as well, and I sit within our secondary advisory team, but we have a fund placement group, and they're constantly, when we see secondary investors will sometimes actually come into the back end of a fundraise where it's more of they call it a pregnant primary or a seasoned primary, and that's really where it's similar concept. The fund has already called 20, 30, 40% of the capital because it's been an elongated fundraising process, and as you get to the final close, there's actually a portfolio to underwrite. You're not actually committing to a blind pool. And so we found secondary investors are also pretty active in that market as well.
Yeah, and again, one of the benefits there is the lack of need to really agree on valuation as much. I mean, if you think about you have $100 million commitment.
There might be like two portfolio companies, right? And so it's really about the unfunded release. Yeah. Right.
So if you have, just to give a numerical example, if you've got a $100 million commitment and you've funded 15 million of it, what the secondary buyer is really buying is relief from that $85 million of unfunded commitments, which is basically done on a dollar for dollar basis. And whether it's a 2% discount or a 15% discount, the absolute dollar discount against the $15 million commitment is much, much smaller in absolute dollar terms than if you're buying a 80% funded portfolio at the same discount. And so it's a way of shifting the exposure on the unfunded. It's providing liquidity to those LPs to get out from under those burdens without needing kind of precise agreement on discounting value. The last one that we wanted to talk about here, sort of these alternative structures, what we call shared waterfall. People call them structured deals, earn-out deals. But basically, you have whatever the secondary assets are, whether it's LP interest or assets underlying LP interest. You have a buyer and a seller. The seller, a frequent way of doing it is you would dump the assets into an SPV, and both the buyer and the seller retain some interest in that SPV, usually with the buyer getting its money back plus some type of return, and then having some waterfall, and it can be very bespoke and very negotiated, being shared over time. Any big upside being shared between buyer and seller over time. It's a way, again, if you disagree on valuation, of kicking the can down the road. Like, you don't have to agree right now what it's worth, because we can allow realizations to tell us what it's worth over time and see how good of an investment it is. It's almost like it is like a structured preferred equity is a way of thinking about it. We have found it to be a very good way to, when you have good deals that need to get done, but just some sticking points on valuation. People worried, sellers in particular, worried about looking like schmucks because they're selling at too low of a value, but not being able to bring that gap. It's a very good way for them to buy that kind of upside schmuck insurance, to get the assets transferred. The buyer actually, the difference between it and preferred equity is the buyer actually gets to control the assets, typically gets to control the SPV and make decisions about the assets, which they obviously would not get to do with preferred equity or NAV-based lending. The downsides of the deal are they're complicated because they tend to be heavily negotiated and bespoke around the particular assets, the particular thresholds, the particular timing, which makes it more expensive and more time consuming. But we have found it to be a very effective tool when appropriate to push deals across the finish line. If we could move just to the next and last slide. So the last slide, in here, what I'd like to do, well, first let me start. We have to do the CLE code. I don't forget. I always forget. So we'll just do today's. Let's do 917 is the CLE code. So for everyone who's looking for CLE, when you print out that form, 917 is the code. When you return it to Lorraine General, whose email is there, just make sure you write in 917. Let me just set the scene that I'd love really here. This is where I think Andrew and Rich's insights will really kick in and will give us a great sense of what's going on. There is a general sense in the market that the Q3 valuations are going to be a bit more reliable, a bit more robust, and reflect more appropriately the new normal. With heading into those 930 marks, we are starting to see signs of increased activity from secondaries market intermediaries like Andrew. We're starting to see portfolios, GP-led portfolios, GP-led transactions starting to reemerge. Pricing has sort of reset. It's estimated to be 85% across all types of investments compared to 92 and 88 in the last couple of years. However, I caution that's across all investment types, including leveraged buyout, VC, and real estate. Leveraged buyout, which makes up the significant majority of the market, actually prices probably more in the mid 90s and has ticked down to the low 90s. So not quite as bad. VC has always tended to skew lower than private equity. The deals that we are starting to see in the market right now are skewed in a couple ways. One, they are skewed very heavily towards GP-led transactions and fund financings. We are not seeing a reemergence of LP portfolio sales, the sort of most traditional of secondary, just yet. I think there was one that is closing at scale, and it's the first one that's closing at scale over the last 6 months. So we'll see if that kickstarts things. But it feels like LPs are not, certainly institutional LPs are not as desperate for immediate liquidity. The markets have rebounded relatively well. That has had a positive impact on their portfolios. And so they're not running to the markets just yet. So we'll see. I think we'll see. Within the GP-led market, we are seeing a big increased interest in single asset and concentrated portfolios. And with that, maybe I will pause and Andrew, ask you, why is that? I mean, so we see GP-leds coming back before LP portfolios, and we see single asset and concentrated portfolios coming back even more so. Maybe you could take us through the thinking of why that's happening and what you think that portends for 3 to 6 months.
Yeah, absolutely. So I'd say, it's a little bit of an ironic situation because historically the secondary market was built around diversification, and now it's almost like concentration is the new diversification. And the reason for that is that it's a lot easier for a secondary investor to underwrite a single company or a basket of 2 to 5 companies than it is for them to look at a really broad portfolio of LP interests and try to figure out 200 companies. And so there's generally speaking, it's easier to diligence in this environment versus kind of buying what's basically like a private equity index or ETF and hoping for the best. That's part one. Part two, there was already the emergence of the single asset market. Probably 2018, 2019 was sort of a kind of a coming of age of that segment. And that's really just an offshoot of the overall GP-led secondary market. And some of the historical context there was, 7-8 years ago, we started to see the first real GP-led secondaries of scale, where someone was basically, they had an older fund that was at least 10 years old. They still had 3, 4, 5 assets, and they knew they were going to need time and capital to get those companies where they needed to go before exit. And so the best way to do that was really to move all the assets into a new fund or a continuation fund and give LPs an off-ramp. There's a total liquidity option where every LP can basically say, yeah, I want liquidity at that price, I'll cash out. Or they can say, hey, I believe in these companies, and or I don't think the price is high enough, and they can roll into the new vehicle. What always became a problem as kind of that market continued to grow as a percentage of the overall secondary market was typically when you get to the end of a fund, there's a mixed bag. Like if there's 5 portfolio companies, maybe 2 are great, 2 are okay, and one's probably a stinker. And it was very hard to sometimes put a price on the table that really kind of, made everyone excited to sell. And so it introduced a lot of execution risk. And so in the past kind of 2 or 3 years, there was a viewpoint, well, what if we just take the 1 or 2 best companies, because we know you're going to get a good price for it, and we know there's a lot of upside, and why don't we just hone in on those? And so what you've seen GPs do is they're getting, into more, as a fund gets more mature, they're starting to really kind of bifurcate where the long-term plays are and where the company, and which companies are kind of out of the value that they can, and they're just going to get out in the normal course. And so what we've seen is that, where GP-led transactions, far long ago used to be kind of mixed bags of assets, the quality, not only the quality of the managers, but the quality of the assets that are trading hands in single asset deals as well as highly concentrated portfolios is very, very high. Like there's just, secondary investors are not going to take major concentration risks unless they are big believers that the company has a bright future. And so what we've seen in COVID is some businesses have been severely affected by COVID. Some businesses have been, not terribly impacted very much at all. And some businesses have actually had a COVID bump. And what we've seen is that the businesses that have had a COVID bump and the businesses that have been not terribly impacted, but there still is a great runway for those businesses, sponsors are thinking about, okay, what's the best thing for me to do as I'm trying to, call it manage the overall fund from a liquidity standpoint, but also not, handicap our upside going forward. And so the single asset solution really, it's kind of the have your cake and eat it too transaction. And there's been some kind of landmark deals that have gotten done in the past 2 years. And as general partners, what I found is we've educated GPs on this solution. There's a real the kind of a light bulb goes off. And so I think we're going to continue to see a lot of single asset deals and a lot of concentrated GP leds going forward. And it's right now, it's as Leor mentioned, the overall market is very skewed to GP leds. But in particular, it seems like, like right after Labor Day, there's usually a bunch of deals that come to market because everyone's back from summer, and and plus you kind of need to launch a deal at the beginning of September if you want to get it done by the end of the year. And let's just say like if 10 GP leds got launched, in the first week of September, 7 or 8 of them were single asset deals, which to me is an astounding stat given the historical context of the secondary market.
Yeah, I agree, and that actually echoes what we see. We've started to see over the last month, not so much the deals that died coming back, but older deals looking for kind of phase 2 financings or follow-on or add-on financing. I think there have been sort of 3 or 4 show up, all single asset, all sort of, I think all sort of offensively taking advantage of great opportunities in the short term. And that is clearly skewed more towards single asset than we've ever seen before. I mean, I think it had been a relatively small part of the GP market, and now we see it well north of 50%. Rich, I don't know, maybe now's a good time to get your thoughts on kind of what you see happen, what you see driving the market over the next 3 to 6 months.
Yeah, sure. So we think that we're going to see largely a continuance of what we've seen so far this year, which is GPs, just as Andrew says, focusing on the portfolio, but with this expanded toolkit. So we've executed deals this year where we've helped GPs support existing portfolio companies. That could be putting more cash in the balance sheet. That can be buying back debt opportunistically at the portco level, where they're able to do that and take advantage of that. But it's equally, if not more so, being opportunistic and playing playing offense and using preferred equity or using a NAV loan. This broad portfolio financing world is a great way to do that, because you can take advantage of the broader fund's balance sheet to access relatively inexpensive and quite flexible financing. That's really one area, more of the same of what we've been seeing, continuing to see more activity from high quality GPs. The other prediction and the other theme that we think we're going to see a lot more of is really a derivative of the GP-led secondary market. So in a number of these transactions, you see GPs either needing to or wanting to put more of their own capital in. So to put more of the GP balance sheet or to put incremental GP commitment dollars into these continuation deals, if they're multi-asset or if they're single asset, you may find a GP that needs to put more money in to show incremental skin in the game, or you may see a transaction where a GP wants to hold one of their prized assets longer, and they have the ability to make an additional personal bet or an additional team bet, which they want to do. So there's more need for capital at the GP team, at the fund management company. Where does that capital come from? Especially in a time when there have been fewer natural exits. So your exit categories 1 through 3, Leor, have been quieter. So maybe there has not been as much proceeds off of previous GP commitments. There's been less realized carried interest. We're seeing more and more GPs talk about and execute GP financing transactions using preferred equity or using fund financing, where they can borrow against their existing balance sheets to make additional investments. So these tools don't just happen down at the fund level. They can actually happen at the GP team and at the management company world too. So we're seeing that market evolve a lot. We're literally seeing new transactions every day there. And given where we sit as kind of smack in the middle between investment banks, secondary firms, GP stake providers, we are seeing a lot of that flow. So we think, broadly speaking, the use and growth in GP balance sheets, both in general, but mostly to support these secondary activities, is going to be one of the drivers of activity. And then what I would say furthermore, which is interesting about all of this, if you look on the previous slide, all those different solutions, those are all fairly straightforward tools within capital markets. They're just being ported on to the private equity industry. If you think about shared waterfall structures, the kind of earnout structure within M&A has been around for a long time. It's especially active now. So it's been really cool to be a part of and really have a front row seat for the continued innovation within private markets.
Yeah, that's a good point. Like, for a long time, the secondary market was an equity-only market, and so people were trying to, there was a square peg round hole issue, and you just knew it was only a matter of time until this traditional corporate finance instruments would get applied into private equity funds to a point where we now have a prep equity market, and we now also have a fund finance market. So you now are just seeing capital structure get applied to private equity funds.
Yeah, we agree with that, but although it has been interesting as it has evolved, it's its own little market, right? Because all of these deals sit somewhere in between M&A expertise and fund expertise. And what we have found is there really is a special expertise that has evolved to cover the secondaries market and these evolving solutions at the intermediaries, with firms like 17 Capital, among law firms. It is emerging as its own market with its own market assumptions and own market practice, which has been fun to be a part of. Keeping an eye on the time, I want to ask one quick question to both of you. So we've touched on a few things, but I want to give you guys an opportunity to talk about what solutions we are, what are the fact patterns that we are solving, right? So we talked about, Rich, you talked about, GPs needing to put more money in on deals. We talked about taking advantage of offensive or defensive opportunities in your portfolio companies, providing capital for portfolio companies in the context of delayed realizations. We talked about a way of hanging on to assets, but still providing liquidity to investors. Are there any other problems we're solving here? You know, what as we look at our audience, you know, in what ways should they be looking to this for solutions? Like what are the relevant fact patterns they should be applying?
Yeah, I can start off there. I think what you know, where solutions like ours and speaking broadly here really come in are there's a real growth among the private equity industry to really nail down the exposure that different investors want. There's investors that want a traditional equity exposure. Other people want more of a credit or mezz exposure. Other people want a levered equity exposure. So as Andrew put it, we came from a traditional equity market. So there's solutions like ours that need to be put in place to really chop up the pie. But at the end of the day, it really comes down to ultimately you have sponsors that have to somehow abide by the kind of the history rules of the 10-year fund life, and that just doesn't always work. There's companies that'll be sold earlier, companies that'll be sold later. So you've seen some evolution in fund structures, but we are making up the rest of that in terms of providing liquidity or providing other solutions for investors that want private markets exposure, but they don't want it in a traditional linear way.
Yeah, good point. Yeah, I would say, and I'm coming at this from the context of a GP-led secondary, but once we look at the portfolio and whether it's a specific company or a collection of companies, when we try to really figure out if there's, call it a deal to do, it's a matter of we look at kind of four things, and you're usually solving for some combination, if not all four of them. Liquidity obviously is first, right? I mean, there need to be sellers for there to be a deal out of the LP base of the fund. Capital, like access to follow-on capital, is typically a goal, because there's usually the companies, you know, the way that they're going to grow is either with growth CapEx or inorganically through acquisitions. And many times some of the best success stories in private equity have been, you know, consolidators of choice in fragmented industries. And so we have done a lot of deals, and I know that Rich has financed a lot of funds that needed access to follow-on capital for add-on acquisition. Next is duration, which is, you know, again, like it's almost like using a continuation fund to extend the life of the original fund and ensure that you have the adequate time to do what you need to do with these companies to maximize the returns. And last but not least, certainly not least, is alignment, or sometimes realignment, making sure that you're aligning incentives with the new secondary investors. And by realignment, many times, if you look at the ownership of the general partner for that fund from 10, 11, 12 years ago, and you look at who's going to be adding value going forward, that should not have the same carry split. And so we found that a lot of times you're cashing out former retired partners and making sure that you have the right people at the general partner being compensated in the continuation vehicle. So there's usually a realignment issue or a realignment solution as well.
So we're almost out of time. We had a whole bunch of questions, and we're not going to be able to get to most of them, but I wanted to ask a couple of them. I think they're relevant. One, and Rich, I think this is directed at you. You'd said that the pref and NAV lending are low relative costs. I think that was one issue that got a lot of attention over the last 6 months, is the kind of the cost of pref versus NAV cost of capital. Maybe you could spend just a minute explaining the relative cost and for pref and NAV lending.
Sure. So broadly speaking, every structure is different here. On the preferred equity side, there are two main ways to really price transactions. There can be a fixed interest rate, which traditionally PIKs throughout the life. That's going to be in the low teens % cost of capital, or there can be more of a hybrid structure that is a perhaps high single digits PIK with some element of upside sharing, what we really look to do is really match how we construct the cost of capital with what the GP or with what the investor is looking to accomplish. On the NAV loan side, more of a fixed cost of capital. It can be floating, i.e. a spread to LIBOR, or it can be fixed. When you're thinking about a single fund solution, that is going to be a high single digit cost. But for all these transactions, they're really priced off of LTV, off of underlying diversification and riskiness, and what the capital is being used for.
Great. And then just one last question. If you have a fund one that, and Andrew, maybe you can take it. I have some thoughts also. Consummates a financing transaction, provides liquidity, extends the term. So sort of think of like a traditional continuation vehicle. What's the impact on the team? Can they get paid carry? Are there restrictions on the team in the documents? Their ability to start to work on the next fund? Like how does that tend to work?
Yeah, so look, because it's an SPV and not a full fund, like in terms of the time and resource allocation, like you're going to still be able to like focus on like your main fund, and whether it's a new fund or an old fund, you're going to be able to do that. In terms of fee and carry, the management fee is typically lower than 2%, but it's usually it's going to be at the new cost basis, right? So just to take a lot of times a single asset deal might be a 1% management fee, but because the cost basis is stepping up from, say, it was originally a $100 million equity check, and now that equity is being repurchased, if you will, at 250, you're making 1% on 250 instead of 2% on 100. So, like you got to look at it kind of on an apples to apples basis. And then in the terms of the waterfall, it's typically a ratchet and carry. So it's tiered based on higher carry at higher hurdles. You typically start around 10% carry, you graduate to a 15, and then graduate to a 20.
And depending on, and I would just add, and then we're going to be out of time. In a lot of continuation vehicle structures and in financings where cash is being sent out to limited partners, there may be opportunities either for the GP to realize accrued carry on the transaction, or in continuation vehicles, a lot of time to essentially convert accrued carry into a capital interest on a tax efficient basis. And so instead of holding like a 20 cents on the dollar profits interest, holding an actual, sort of full capital interest with dollar for dollar participation in the continuation vehicle, which a lot of our sponsor side clients have found to be a very attractive byproduct of these continuation vehicles.
Oh yeah, you are correct. Yeah, you're crystallizing it and you're rolling it as basically a GP commit in the form of a capital interest. And so that is the way I do it is like that's in a way, you are realizing it, right? Like you're de-risking that carry in many ways and taking it out from a cross-collateralized pool that has a very high beta, depending on how the rest of the portfolio does, to, oh wow, this is just GP commit now on a go-forward basis, and I have another bite at the apple if we do a very good job with this asset going forward.
Yeah, and like I said, sponsor clients have found a very attractive byproduct of these deals. With that, though, I think we are out of time. I want to thank Rich. This was a terrific conversation. I want to thank Brian and Dimitri and everyone at Major Lindsey and Heather for running everything, and all of our participants. In case you missed the code before, it's 917. Make sure you put that down. And thanks, everyone.
Thank you, everybody.
Thank you.